Chapter 1, Accounting, the Language of Business. So in Chapter 1 of the college accounting textbook, we're going to talk about what basically is accounting. We're going to identify the financial statements that businesses prepare, and also talk about the users and various careers that you might have in accounting as well. And so, as you can see, here's the standard definition of what accounting is. And just a couple things they talk about as a process by which, notice it's financial information about a business is, and then here's what we're going to be studying in each of the chapters. We're going to talk about how you can classify, record, summarize, interpret, and finally communicate this financial information to the interested parties, which could be owners, managers, and other people. We're going to talk about what's called internal users and external users. But one thing I'd like to just emphasize is that accounting is going to be a communication idea, and it's basically going to be how you communicate, again, financial information, about a business to your investors or your creditors or your internal users or your external users. But the idea is communication is a big part of accounting. And later on we'll get into financial statements, but basically the basic financial statements that you're going to be doing in applied accounting is what's called the income statement, the equity statement, and the balance sheet. And notice that this is how a business will communicate the information to the users. And you're going to find that as we go out throughout the semester, I'll bring some stuff and I'll post on the Blackboard site. But there's a lot of careers and job opportunities into accounting. This slide mentions accounting clerk, bookkeeper, accountant. There's a lot of stuff that this slide doesn't include, but auditing, taxes, consulting work. Typically you get your degree in accounting and you'll be able to branch off, and not just to do the stuff we're going to do in this class, but typically just having a knowledge of accounting is going to lead to other job opportunities. The three basic areas that accountants typically work are number one, public accounting. There's also number two called managerial accounting, and then three called governmental accounting. And obviously there could be a hybrid of all these three. In public accounting, you're talking about your CPA firms. Auditing is a big part of what they do, because according to the the SEC and a lot of the federal regulations is that companies have to be audited by independent accountants. And so that's what these CPA firms typically provide, but that's the public accounting area. They also do taxes, and then advisory services, which is basically consulting, makes up another big part of their revenue. So since I did mention CPA firm, you come across this, what is a certified public accountant? Basically, to be certified, you actually have to pass an exam. It's called the CPA exam. And to do that, obviously you have to have the educational background just to be able to sit for the exam. And if you ever get interested and you're wanting to know more about that particular area, you could always just email me and I can always talk to you individually. But this is kind of like what the independent auditors at the CPA firm do, is they're a certified public accountant. They've got that certification, so therefore that's recognized by Congress that they are qualified to look at financial statements. Managerial accounting sometimes is referred to as private accounting, but the basic idea is you could be working at like Boeing or Monsanto in the operational accounting department, and typically that would be referred to as what they call managerial accounting. You're making decisions, you're using financial statements and other financial information within the company to help direct the company and make good decisions about how to lead the company. Governmental accounting is another branch of an area that typically you might want to be interested in going into, such as you could work for the FBI, the IRS, and there's various agencies, even in the St. Louis area, like there's defense contract audit agencies. There's so many agencies that relate to government that can give you opportunities for employment. So when you see some of these governmental agencies, you've got the Securities and Exchange Commission, IRS, FBI, Department of Homeland Security. The one that I'm kind of going to mention right now, the SEC, you're going to find that that is the governing body of accounting is the SEC, Securities and Exchange Commission. And they basically oversee all of the accounting rules you're going to be studying in this class and perhaps the next class if you take financial accounting. And I already talked about, you have, internal users and external users who are both interested in financial reports. Internal users being, the owners, managers, employees of the business. External users being, the IRS, the government, suppliers, SEC, banks, which your creditors, people are interested in. If they're going to get, loan you money, they want to look at your financials. Customers, potential investors, unions are considered external users. And in the next couple slides, I'll walk you through maybe some of the reasons why our supplier is interested in the financial information of a business. Well, if you think about a supplier, for example, if they're going to extend credit or do business with a potential client or a customer, they want to know ahead of time, hey, look, what's your cash flow? Can you pay your bills before I start shipping you supplies? Because then I'm going to put, my business at risk. So, suppliers are definitely interested in. Banks, you walk into a bank and you ask for a loan. So what's the bank going to ask for? They're going to look at, okay, they want to know your income, they want to know your debt and so forth, and all these things are on financial statements. So banks are always interested in looking at financial information, and I like to basically say they like to assess risk to determine whether it's a good idea to loan you money. Obviously, the tax authorities, are interested in your income. They want to know, how much tax should you be paying? Did you file the right amount of tax? Did you pay your sales tax? Did you pay your property tax? All these things at some point in time, if you're in a business, could be audited to ensure that you are paying the right amount of taxes. And if you follow the news, every now and then, you'll find a business that gets into issues where they owe the IRS money, based on either underpaying their taxes or misreporting their taxes. But the tax authorities have access to these financial statements. And of course, I said this earlier, the SEC, they basically oversee all the financial accounting for the public companies. Okay, and we'll get into what a public company is later on, but basically a public company would be like Coca-Cola or Pepsi or Nike. They actually sell stock on a public exchange to the public. Okay, so there's got to be rules and regulations, and the SEC is the group that oversees that. You'll read about this thing called the Sarbanes-Oxley Act, and for short, it's often said, okay, this is SOX. That's kind of easy to remember. But this was as a result of some major fraud back in, I believe it was 2001, 2002 with a company called Enron, where the investors were defrauded, that the company lied to the public. There was a lot of, funny accounting going on. The independent auditors were not really independent, and so there was a lot of bias there, and so it really shook the industry in terms of public trust. So what basically happened is that they came up with this Sarbanes-Oxley Act, and you'll have to read about. There's a couple pages in the book that talks about some of the details in terms of what a publicly traded company has to do. But the idea was to crack down on the fraud and the corruption that was taking place at publicly traded companies. And the next couple slides, you've got customers. Obviously, customers are interested, in financial information. Obviously, if you want to determine whether you want to continue to do business or to provide support, it might, have some long-lasting impacts on you as a customer by, knowing what is in a company's financial information. I always tell people when you first get hired onto a job, look at a company's financial statements. Look at their health. Before you go out there and make a big purchase, you want to make sure that the company's not going to go bankrupt and then you're now looking for a new job. So I believe that, as an employee, you should always be aware of, what's the health of your company financially, so that you can make wise decisions regarding, your your retirement, and possible future employability. And the idea is hopefully to minimize your risk. Okay, so now we get into some more business, specific, terminology things. And again, accounting, which is said to be the language of business. So we're going to get into the different types of business entities and talk a little bit about what's called generally accepted accounting principles. So this is a general term, not just for accounting, but the basic idea is there's actually what they call three major legal forms of businesses. One would be called the sole proprietorship. Two would be called the partnership, and then number three, we're going to call that the corporation. Okay, and we'll talk about each of these in a minute and how you can kind of distinguish the characteristics among these three and how they're different, and we'll talk about the ownership idea. So a sole proprietorship is a pretty simple idea. It's basically a business that is owned by only one person. So you are responsible for the expenses. You got to pay the taxes, but the good thing is you also get all the revenue too because it is your business. So it's a sole proprietorship, and I think of all the three, it's probably would say it's the most risky because you are responsible, but also could be one of the most rewarding because you also get all the profits as well. So this slide shows ownership, one owner. Of course, the life, it just depends on when the owner wants to carry on the business. And responsibility is all on that one person. So again, most risky, but it could also be one of the most rewarding as well. And you'll find that later on, some of the companies that are now corporations typically started off as sole proprietorships, and then eventually they started to move up to this idea of a corporation, which we'll get to in a moment. Like, think of Facebook. Facebook initially was just owned by the Mark Zuckerberg, and now it's owned by more than just Mark Zuckerberg. But we'll get to that in a moment. But right now, sole proprietorship is typically where you start. And so if a sole proprietorship is one owner, a partnership is basically said as a business that is owned by two or more. I mean, you could have 1,000 partners, but the idea is it's got to be at least two. And basically, once you are in a partnership, you have some responsibility to share the debt and the taxes, but you also get to share in the profits. And again, but that's why it's called a partnership. So in this slide, you can see how we're trying to distinguish the characteristics. Again, partnership is two or more owners. Typically the life of a partnership ends, and here's some different ways. Either, the partners die, they decide to close the firm, or one of them withdraws. And then notice how the responsibility is basically shared. And here's some basic, examples. This is an accounting class, so you got to say accounting firms are typically looked at as partnerships. But you've got, medical practices, dental practices. If you ever go and get your teeth cleaned, look at the names of the people on that work at the facility. Typically, it's a couple of brothers or a couple of doctors that teamed up to form a practice, and they share their expertise. Doctors do it all the time. Architect firms, law firms, but just look for a partnership is basically the two or more, but it's all a shared responsibility. But probably some of the most common ones you've seen is like the dental practices and some of the medical practices if you go to a doctor. Okay, the one thing about a corporation, notice it says a corporation it's a publicly or privately owned business. It's separate from its owners and has a legal right to own property and do business in its own name. And so basically you're going to find that the corporation is the one idea that compared to the other two, that is what they call a separate legal entity, and therefore it is also a taxable legal entity. So it can be taxed separate from the owners. Okay, so that's kind of like a big deal. So a corporation, you could have a big corporation such as Facebook or Apple, or you could have a smaller corporation that's privately held, like let's say the St. Louis Cardinals. The St. Louis Cardinals are in what they call an LLC, a limited liability company. It's considered a corporation, but it's a privately owned corporation. But nonetheless, because legally, because it is set up as a corporation, they are taxed separately. And here you can see some characteristics of the ownership. You could have technically one owner. You could still be a corporation if you have some apartments that you want to incorporate. And the reason you want to do that is it's going to limit your risk because once you set your business up as a corporation, if there's a problem with the corporation and the corporation goes bankrupt, they can't come after your personal property. So that's why it's always a good idea to get incorporated, to limit your risk, because you will have limited liability. But that's one of the reasons people do, or companies become corporations. Okay, life is basically indefinite life. Obviously, it could end if the company goes bankrupt. The stockholders could liquidate the company. And there's various ways and reasons that that corporations can cease to exist. But obviously, you're not going to stay in business if you're not making any money. Okay, and the nice thing about down here is where it says stockholders can lose only the amount that they invested. That's your limited liability. If you've got $100 invested in a company and the company goes bankrupt, you lost $100, but they can't come after your personal property. So there's your limited risk. Stock is basically what they call, it's a form of ownership. So you can buy shares of Walmart stock and you're actually considered a part owner. Okay, you may not be a majority owner, but if you have one share of Walmart stock, you're what they call a stockholder, and you are entitled to certain rights and privileges for owning at least one share of stock, but it's called a stock certificate. And like I said before, we'll get into this a little bit in this chapter and the upcoming chapters. In terms of looking at these business entities, obviously, you never want to mix your personal records with a business's record. So we're always going to consider that each business we look at, it's going to have its own set of records, to do the financial statements. But the one I said earlier is, in terms of legal entities, the corporation is the only one considered a legal entity, and the idea there is they can be taxed. Okay, they're going to be taxed as an entity. So like if you are in a CPA firm and you are a partner in a CPA firm and you study this enough, the taxes still flow through to the individual. The actual partnership doesn't get taxed, but the actual partners get taxed at the individual level. Okay, that's different than a corporation. With a corporation, you could be a shareholder, but you're not going to be taxed on the corporation's profits. The corporation itself, as a legal entity, will be taxed on its own profits. And so the separate entity assumption, again, is basically going to be where the company has its own set of records, its own financial statements, its own checkbook. So you're not going to mix the business with your personal records. Separate entity. Generally accepted accounting principles, in short, it's often referred to as GAAP. Think of these as, this is the rules. These are the rules that are going to be used industry-wide in whatever company we're looking for. But this is essentially what we're going to be studying in accounting, are the rules, which is, for short, is called GAAP, Generally Accepted Accounting Principles. And this slide kind of gives you an idea in terms of development of GAAP. I'm just going to say one thing. Notice SEC is the governing body of all the GAAP. But over here, do you see this thing? It's called FASB, F-A-S-B. That's called the Financial Accounting Standards Board. And just to keep this simple, that's the group that writes GAAP. So FASB is the organization that is responsible for writing the law, and they basically report to the Securities and Exchange Commission. Okay, an auditor's report, I mentioned this earlier. Basically, an auditor is going to look at a company's financial statements and issue an opinion. And whether the opinion is fair, that the company is reporting fair financial statements. But typically, companies need the auditor's report just to be able to trade, for example, stock, and also to have the trust of the investors or the public. Okay, so this is a big deal. So the auditor's report is basically an independent auditor is going in and looking at a company, and then once they've reviewed the financial statements, they're going to express opinion about their financial statements. It's called an auditor's report.